Hi everyone, and thank you for joining us today. My name is Afrona, and I'm here with Matthew, Nermina, and Sofia, our offshore rig experts. We're thrilled to have you with us today and look forward to an insightful session together. Today's webinar is a special one. It marks our final session of 2025. We'll take a comprehensive look back at what has been a challenging year for the offshore drilling industry. Matthew will review some of the most significant events and explore how they have impacted demand, day rates, and provide forecasts for both floaters and jackups. Furthermore, Nermina and Sofia will share valuable insights into the North Sea market, discuss rig values, and provide an outlook for 2026. All data presented today is sourced from the Esgian Rig Analytics and Rig Values platforms, along with our own research and analysis. We'd love to hear from you, so please feel free to drop your questions or share your thoughts in the Q&A chat box anytime during the session. We'll cover them towards the end, and if we will run out of time, we'll follow up with answers privately as usual. Please note that a recording link will be made available to all attendees tomorrow. We hope you find today's session valuable. Matthew, over to you.
Thank you very much, Afrona, and thank you everybody for joining us for our webinar today, heading towards a brighter future, offshore rig market review and forecast. My name is Matthew Donovan. I'm Head of Rig Market Research here at Esgian. Moving on to our presentation today, I'll be starting with our floating rig and jackup markets, including reviews of 2025 and forecasts for 2026, then a longer-term forecast for offshore rigs. After that, we'll have Nermina give us a special presentation on the North Sea, and Sofia will be presenting offshore rig values. Starting with the floating rig market in 2025, where near-term availability remained an issue for drilling contractors through the year. The working rig count and competitive utilization for floating rigs, including drillships and semi-submersibles, trended down over 2025 as contracts ended and new work being fixed trended towards start dates in 2026 and beyond. And this led to some increased near-term availability in the market, though availability has been reduced recently by recent new fixtures, extensions, and exercised options across the globe. Competitive utilization for the drillship market peaked at 86% in April 2025 and has since settled at around 78 to 81% in recent months. For the semi-submersibles, competitive utilization has remained around 87 to 89% over the second half of 2025, down from 72% in May 2025. Floating rig demand that had previously been projected for 2025 has moved into 2026 and 2027, a combination of capital discipline on the part and cautious spending in the face of economic uncertainty, in addition to supply chain bottlenecks and other miscellaneous delays. As the market slowed in 2025, we saw major drilling contractors lean into fleet downsizing, with 14 floating rigs sold for recycling this year and at least 2 further units currently held for sale. With the delivery of the Tidal Action earlier this year, only one 7th-generation new-build drillship remains. And also this year, the Dorado and Draco drillships, which were available, were sold to state oil company TPAO this year, further reducing the number of available floating units in the market. Looking ahead now to 2026 with our floating rig demand forecast, we see floating rig demand trending upwards over the coming year. Drillship demand remains somewhat flat from late 2025 to early 2026 as rigs continue to roll off contracts and upcoming contracts begin later in the year or indeed in 2027 for some units. However, discussions are continuing around several long-term contracts for work beginning in mid to late 2026, in addition to the work starting in 27 onwards. So we should see some more fixtures announced in the coming months. Based on these contracts already fixed and those under discussion, drillship demand is expected to trend upwards over 2026, with competitive utilization reaching around 90% by the end of the year. Most projects in the near term are based on break-even points lower than expected commodity prices, so are unlikely to be delayed due to the commodity price fluctuations. We see drillship activity remain focused in the Golden Triangle, with some stable demand for the US Gulf projected over the coming year, and rising activity levels in West Africa and South America. This will also be buoyed by activity in the Mediterranean, Southeast Asia, Middle East, the Mediterranean, Southeast Asia, and India. In Brazil, Petrobras has lowered its anticipated rig demand in coming years. That still remains a key market for floating rigs. The semi-submersibles, we see demand flat in the near term. That begins to strengthen on some expected increased activity in both the North Sea and the Mediterranean, bolstered by stable demand in most other regions. Harsh environment semi-activity is concentrated in the North Sea, with some continuing harsh environment contracts in Australia and the Orange Basin over 2026. And as always, timing on certain floating rig requirements remains uncertain and may be pushed further into the future if necessary, based on rig availability or other project issues. Moving now to our floating rig day rate forecast, where we are projecting some modest improvements in floating rig day rates over the coming year. Momentum for floating rig day rates largely halted in 2024 as availability for these rigs increased. And over 2025, we saw drillship day rates as largely flat for much of the year, trending around the mid 300,000s to mid 400,000s for drillships. Day rates for floating rigs are expected to remain relatively flat from late 2025 into early 2026, with some upward momentum towards the end of next year as demand and utilization strengthen. Operator preference for 7th generation drillships is expected to lead to some greater momentum for their day rates towards the end of 2026, potentially bringing leading edge day rates back into the high 400,000s by the end of the year. As utilization tightens in 2026 and 2027, some higher day rates may be seen on short-term jobs with limited lead times. And the high regional operating costs and smaller pool of available rigs has kept day rates for harsh environment semi-submersibles stable and among the highest globally. Moving now to jackups as our overview for 2025. Suspensions continued to affect the jackup market over this year. Jackup demand in 2025 was negatively affected by Saudi Aramco's continued suspensions and to a lesser extent suspensions and payment issues related to Pemex in Mexico. Jackup demand this year was also affected by operator caution in the face of economic uncertainty, including commodity prices and potential effects of tariffs, pushing some projects into the future. What we have seen this year is drilling contractors seeking out new markets beyond their traditional areas due to this uncertainty. This has included drilling contractors moving into newer regions that they may not have operated extensively in before, and new forms of work, with some drilling contractors turning to accommodation work or work in the renewable space. Demand for jackups was around 365 to 370 units for much of 2025, with some monthly fluctuations as rigs rolled on and off contract. Competitive utilization in the market briefly dropped below 80% in early 2025, but has stabilized at around 83 to 85% over the past 6 months. And we saw the makeup of the jackup market change significantly this year, with ARDES completing the takeover of shelf drilling and now standing as the largest owner of jackups. Further to this, Noble will be divesting a large portion of its remaining jackup fleet in the near term. Moving ahead to our jackup demand forecast. Utilization of the jackup market remains strong next year, reflecting the base of long-term activity in the Middle East, Southeast Asia, and other regions. We see demand picking up as rigs are projected to return to work in these regions. After an extended period with jackups under suspension, Aramco is preparing to return units to work in early 2026 and is also preparing to launch a new tender for jackups in the new year, with work potentially beginning in late 2026. The Middle East remains the single largest region for jackup demand, along with large contributions from India, Southeast Asia, Far East, and Mexico. In Mexico, Pemex has begun signing extensions for some jackups through 2026. And we also see tenders under discussion for new fixtures with ONGC in India and with multiple operators throughout Southeast Asia and West Africa. The preponderance of brownfield projects will make some jackup demand less susceptible to commodity price fluctuations in the near term. However, the potential remains for some projects to be delayed, particularly exploration work. For the jackup day rate forecast, we expect day rates for both standard and premium jackups to remain relatively flat over 2026. Drilling contractors have taken some lower day rates to secure market share in new regions in recent years, but premium jackup day rates have held steady in recent months. Availability in the near term is expected to keep day rates flat from late 2025 over 2026 in the near term, with major operators like Aramco still having an advantage in day rate negotiations. And we expect the high desirability of premium jackups for certain projects will boost their day rates compared to lower spec standard units. Moving forward now to a longer term forecast. A brighter outlook in the longer term, we see some positive indications for continued demand in both the jackup and floating rig markets. While there remains uncertainty in the market over commodity prices and other economic factors, we do see some positive indicators on the horizon. Demand for rigs has moved forward rather than disappearing entirely, with drilling start dates, as I mentioned, moving into 2026 and beyond. And capital discipline from operators means that recently sanctioned development projects have relatively low break-even points and will likely remain profitable even if commodity prices trend downwards in the near term. Even with an increase in renewable energy resources, the world continues to need fossil fuels over the next 2 decades, and operators will need to increase drilling levels in order to replace declining reserves. The IEA now indicates that oil and gas demand could continue to grow until 2050, and offshore drilling will be part of meeting this demand. As mentioned, Saudi Aramco is starting to return jackups to work and beginning a new tendering process, which will tighten the jackup market. And new deepwater developments offshore Namibia and Suriname and continued demand in Brazil, Guyana, the US Gulf, and other areas will help maintain the demand for floating rigs. Recent attrition and limited new build activity limit the potential for rig oversupply in the coming years. And we should see day rates for 7th generation drillships and premium jackups improve in 2027 and 2028 as utilization rises and operators require these high-spec units. I'll be turning the presentation over now to Nermina with market insights on the North Sea. Thank you, Nermina.
Thanks, Matthew, and hello, everyone. We'll start with a visual breakdown showing the region's present rig count, contracted fleet and available units before turning to key events that shape today's landscape and concluding with the outlook. Compared to recent years, which were marked by attrition through departures and scrapping, offset by modest inflows, there were no significant supply fluctuations in the North Sea region in 2025. The few exceptions include the sale of an idle jackup that has since left for Vietnam and another jackup sale that effectively removed that unit from the competitive drilling market. So the resulting supply overview for the region, excluding Russia North, shows a fleet of 55 units, that is 26 semi-subs and 29 jackups, but the practical availability is far smaller once we account for operational status and other constraints. At the moment, 41 units are drilling and another 6 have future commitments. Cold stacked and uncompetitive assets further reduce near-term supply, leaving only 4 readily available rigs in the accessible pool. Overall, the chart illustrates how the headline supply figure contracts sharply when adjusted for contract coverage, technical readiness, and reactivation potential, showing how small the pool of available rigs actually is. Next slide, please. Turning now to contracting activity in 2025. Overall, the total backlog awarded in the North Sea edged higher in 2025 relative to the prior year. The top right chart also shows that new awards were more heavily weighted towards the second half of the year, with August and November standing out as particularly active months. The contracting activity in 2025 was driven by the semi-submersible segment, particularly in Norway, and especially in the second half of the year. This marks a shift from the prior year when jackups dominated the contracting landscape. The whole region, however, has been in decline since 2023. On a country basis, Norway awarded more backlog in 2025 than in 2024, driven primarily by the semi-sub segment. In contrast, the UK awarded less backlog than in the previous year and remained more resilient on the jackup segment. The past year has shown that the UK and Norway continue to move along increasingly divergent policy paths, with the UK tightening its fiscal framework, while Norway maintains a more stable environment for long-term investment. The UK government has recently confirmed that the Energy Profits Levy will remain in force through March 2030, unless terminated earlier under the Energy Security Investment Mechanism, which is triggered if oil and gas prices fall below predefined thresholds for a sustained period. The government has now also confirmed that once the EPL ends, either through ESIM or at its scheduled expiry, it will be replaced by the Oil and Gas Price Mechanism, which is a permanent revenue-based framework that applies additional taxation at a rate of 35% when prices exceed specified levels. While the government hasn't responded to industry calls to remove the EPL, this at least provided greater clarity on the post-EPL fiscal landscape. In Norway, the political climate around oil and gas remains fundamentally different from that in the UK. Despite facing a budget crisis in early December, after the Green Party demanded a gradual phase-out of the oil industry by 2040, the budget deal was ultimately secured, reinforcing the view that Norway's medium-term production and investment trajectory remains largely unchanged. Next slide, please. Taking all these dynamics into consideration, we can now examine how they influence the outlook in the North Sea. After a softening in the second half of 2025, overall demand in the region is expected to remain at a slightly lower level into 2026. The decline in jackup demand, driven by units rolling off contracts, is projected to be partly offset by 3 semi-subs starting new contracts in the UK and 1 semi-sub in Norway, all in early 2026, alongside contract commencements for 1 jackup in each country later in the year. Excluding any new awards in the coming period, this maintains the demand at a lower but stable level. In the previous section on contracting activity, we've seen that jackups have received fewer awards this year compared to 2024. This, combined with shorter lead times and contract durations in the segment, means that a notable share of the backlog awarded in 2025 is already underway, and most of what remains will wrap up in 2026. The remainder of the awarded backlog in the segment is scheduled to begin in 2026, with most programs concluding within the same year, and only a marginal share extending into 2027. This indicates that a bulk of activity in the segment is concentrated in the near term, while visibility declines sharply beyond 2026, highlighting limited long-term exposure. In contrast, only a small portion of the semi-sub backlog secured in 2025 started the same year. The majority of the awarded backlog starts in 2026, with end dates ranging from 2026 to 2029. The remaining backlog is scheduled to start in 2027, with most of it concluding that year, and with one exception extending into 2028. This points to stronger multi-year visibility and signals a pipeline of work that will sustain the segment over the medium term, without relying heavily on short-cycle contracting. This divergence highlights a North Sea market in which short-term fluctuations will largely be felt in the jackup fleet, while semi-subs benefit from firmer medium-term commitments. Against this backdrop, the limited near-term opportunities for idle units in the region may signal more departures in the coming year. And that's it from me. Take it away, Sophia.
Thank you, Nermina. Hello, everyone. So today I will walk you through this part of the presentation where we cover rig values in 2025 and where we're going to see market trends, our exclusive top 5 contractor series, as well as a 5-year outlook. Next slide, please. Okay, so we start our presentation today looking at values in 2025. As we have seen in detail by now with Matthew and Romina, both the Jackup market and the benign floater market, they were heavily affected this year by uncertainty in the Jackup market with the suspensions and the floater market due to demand being pushed late 26. However, when we look at the harsh environment segment, we see that it has showed actually more resilience this year. When it comes to premium Jackups, as we can see in the chart, the top chart in the slide, the values, they were continually adjusted down throughout the year. And again, that's due to the uncertainty in the market. And by December 2025, they were averaging 77 million. When it comes to the North Sea harsh environment Jackups, the values, they declined throughout the year, but they were less compared to the premium Jackups, and the average for overall 2025 was around 183 million. As we can see, when we compare to pre-pandemic levels, the values for both segments has not yet recovered. Now, when we move into the floater market and the charts below, we see that, again, the values, they have declined quite significantly when compared to 24 and 2023. And when we look at the harsh environment segment, we see that it has remained somewhat isolated from this global market softness. When it comes to the 7th-gen drillships, they declined around 16% since January this year, and they average around 316 million. Now, when it comes to values for the 6th-gen drillships, they declined a bit more in around 18%, and since January, averaging around 184 million. Now, moving to the chart to the left, the NCS harsh environment semi-subs average around 330 million, and the 6th-gen international semi-sub values, and it's important to note that this segment was the most affected by the current market softness, declined 22%, averaging around 89 million. A very interesting fact to mention is when we look at the values for both the 7th-gen drillships and the NCS harsh environment semi-subs, we see that today, at the end of 25, they are at similar levels to 2018, even with the continuous decline that I've just presented here. Next slide, please. Now, here we come to our exclusive Top 5 Drilling Contractors series. It's a series that the team launched this year. On the first half of the year, we covered the Jackup market, and on the second half of the year, we covered the floaters market, and the last article actually came out just a week ago. A few interesting things about the Top 5 Jackup series is starting with the Jackup market here on the left. In general, in the last 10 years, the top 5 for the Jackup market has changed a lot. And as we can see, it has already changed again this year in the direct result of the this shelf drilling fleet merger. Now, as even Matthew mentioned, ADES is the largest Jackup owner by far, and accounts for around 40% of the total top 5 fleet, and around 20% of the total competitive global Jackup fleet. So we're seeing here a very big consolidation in the Jackup market. Another interesting fact is that this configuration that we're seeing here for December 2025 is soon to change again, with Noble's announcement last night that it's selling 6 Jackups, 5 of which will be potentially acquired by Borr Drilling, which will increase its fleets to 29 rigs. Now, when it comes to the floater segment, the top 5 actually has remained largely unchanged through the decade. And a major trend was that those top 5, they have aggressively divested older units, especially semi-subs. When it comes to the fleet valuation for the top 5 floaters, a very interesting fact is that when we look at ODFL drilling's harsh environment fleet, it is composed of 5 rigs. However, its valuation, especially after the Deep Sea Bolster acquisition, is around 2 million. So if the top 5 were actually in terms of fleet valuation and not fleet size, ODFL would make the top 5. Next slide, please. Now moving on to rig sales and M&A. This was an active year in terms of rig transactions and M&A, as we have seen. Apart from the ADES shelf drilling takeover, there were 29 rig sales to date. The vast majority, as we can see from the table to the left, was for non-drilling purposes. That again emphasizes the focus that the contractors have been having since early 2024 on fleet optimization. A few highlights about those transactions was Transocean, for example, which sold 8 rigs for recycling, 6 drillships, and 2 semi-subs. We also have the ODFL Drilling acquiring the Deep Sea Bolster. When it comes to Jackson, the company purchased the Sea Challenger Jackup for around 31.5 million, and it's very important to note that that includes a 3-year contract with ONGC. That's why we have this sale value. And when it comes to Valaris, similar to Transocean, the company sold 6 rigs, 3 semi-subs for recycling, 1 jackup for conversion, and 1 jackup for drilling. Next slide, please. And now we get to our 5-year forecast. This forecast is marked by the current market uncertainty, by cost cutting, and how that has been putting a lot of pressure on rig values. An overall trend that we can see, especially for the low end of the forecast, is that for 2026, values are going to be flat to slightly negative. We do expect, as mentioned by Matthew, demand recovery in early 2027, and that is what we have, as well as with backed by day rates, to see rig values going up from early to mid 2027, depending on the rig type. With that, we also assume a slow decline towards the end of the decade. For again, it differs slightly from rig type and from market. When it comes to the 7th-gen drillships and the NCS harsh environment semi-subs, they are, again, the most valuable assets, and we do see that moving forward until the end of the decade. When it comes to the overall trend in rig values, energy security, depletion, and renewables slow down, they will help sustain rig demand, and that goes hand in hand with sustaining rig values and driving rig values up in the middle of the decade until the end of the decade. Next slide, please. And now here we come to our rig market predictions for 2026. We have 5 predictions here. Number 1, there will be some continued availability of floating rigs and jackups in the first half of 2026, but demand is expected to rise towards the second half of the same year. Second, the day rates for most rig types will be stable from late 2025 into the first half of 2026, with some upward for 7th-generation drillship towards the end of the year. Floating rig attrition will slow in 2026 after many older cold-stacked units were sold for recycling in 2025. Further retirement of older jackups is likely. Now, when it comes to rig values, values will be relatively flat in 2026 with 7th-generation drillships and the NCS harsh environment semi-subs most likely being the first ones to start recovery already by mid-2026. The jackup market consolidation could drive certain rig owners to continue divesting their jackups to focus on floaters. And with that, I hand back to you, Afrona. Thank you very much.
Thank you, Sofia. Thank you, Tim, for these interesting presentations. Unfortunately, we are right on time to finish this, but I love questions, so let's take maybe one or two of them, and the rest we'll address them privately after. So first question, how do you see semi-demand in Brazil in the coming years? Is there any expected defined scope of work, new tenders with major operators versus privately contracted work, especially from smaller operators?
Okay, so I think what we'll see for semi-demand in Brazil, we do see some potential new tenders or extensions over the next couple of years with both Petrobras and with some independent operators. I think there'll be some tenders in the market. There's a letter of intent under discussion right now for some semi work in the new year with Karoon. So it will be a mix of Petrobras extending rigs that it already has versus smaller, shorter term work from independent operators.
Thank you, Matthew. One last question. Is there potential for cold stacked units to be reactivated?
Yeah, probably not in the very near term, but certainly as demand is projected to rise over the next couple of years, we could see some of the cold stack units that have been held on to reactivated. We have seen recently some jackups being brought back into the market, and again, there's other cold stacked drill ships that have been sort of relatively recently cold stacked. Those are being held sort of in reserve to meet future demands. So certainly some potential for reactivation over the next several years.
What about new rig orders?
The only new rig orders we're seeing sort of in the near term come from Arrow Drilling in Saudi Arabia, but other than that, we're not really projecting any new rig orders. Project economics just aren't there for that at this time, so unlikely to see any new drill ship or semi orders or jackup orders outside Arrow Drilling over the next couple of years.
Thank you, Matthew. Thank you, team, and thank you all for joining us today. On behalf of the Esgian Rig team, we wish you all a wonderful holiday season when it comes and a smooth start to the new year. Cheers, everyone. Thank you.
Thank you all.
Thank you all. Bye-bye.